For decades, a quiet conspiracy unfolded in plain sight, not in back alleys or offshore accounts, but in the very heart of global finance. Every mortgage, every student loan, every national debt payment was built upon a number, a single number that the world trusted without question. It was supposed to be objective, scientific, and precise. But behind that number was something far more human and far more corrupt. Welcome to FinLore, where money, power, and history collide, and nothing is ever as it seems. In the world of finance, everything has a price, even trust. And in the late 20th century, that trust was given form through something called LIBOR, the London Interbank Offered Rate. It was never meant to be famous. It wasn't a stock, a currency, or a government bond. It was simply a reference point, a number used by banks to decide how much interest to charge each other when lending money. But as the global economy grew, so did LIBOR's influence. By the early 2000s, it wasn't just a benchmark for bankers. It was the backbone of over $350 trillion in loans and contracts around the world. From your credit card to your country's national debt, everything was quietly pegged to LIBOR. And yet that number wasn't determined by market forces or transparent data. It came from a daily questionnaire. Each morning, the world's biggest banks, Barclays, JP Morgan, Citigroup, UBS, Deutsche Bank, were asked one simple question. If you were to borrow money from another bank today, what rate would they charge you? They'd each send in their answers. The highest and lowest were thrown out, and the rest were averaged. That average became LIBOR, the price of money for the entire planet. Elegant, efficient, and catastrophically naive. Because those answers weren't based on actual trades. They were based on honesty, a virtue in short supply on Wall Street. At first, no one questioned it. The system worked. Banks lent, markets thrived, and the global economy surged. But inside trading floors, another realization began to spread. A realization whispered over phone calls and confirmed in private chats. If a small change in LIBOR moves billions, what if we nudge it ourselves? It started small, a single trader asking a colleague to shade the number a little lower, just enough to push a trade in his favor. Hey mate, keep LIBOR down a bit today, got a position that depends on it. Sure thing, you owe me one. Tiny adjustments, invisible movements, and billions shifted silently across the world. The beauty, or the horror of LIBOR, was that its manipulation was too subtle to see. A few hundredths of a percent, a few words in an email. But those fractions dictated who could afford a home, who could expand a business, and which governments stayed solvent. By the early 2000s, those nudges became coordination. Traders across continents, from London to Tokyo to New York, created secret chat rooms with names like the cartel and the mafia. They joked about fixing the fix. They sent each other champagne, tickets to Wimbledon, even promises of favors. Every morning, they moved the needle, up or down, depending on what would make them the most profit. This wasn't hacking. It wasn't a data breach. It was the system itself, bending in the hands of those who ran it. And regulators? They trusted the banks. They believed that institutions worth trillions wouldn't lie over a few decimal points. But in finance, a few decimal points can change the world.
Banks submitted artificially low borrowing rates to appear stronger than they were. The heartbeat of the financial system kept ticking, even as the patient was in cardiac arrest. One economist later said, LIBOR was the thermometer that said 98 degrees while the patient was dying. Regulators looked the other way. Governments needed stability, not panic. And the lie became policy. but you can't bury the truth forever. In 2012, a series of whistleblowers and investigative journalists began to unravel the story. It started with Barclays Bank, which admitted to submitting false rates. The emails they handed over shocked the world, not because of their content, but because of their tone. This wasn't a secret criminal syndicate plotting in shadows. It was traders laughing, joking, and casually rigging the global economy from their desks. One message read, "Done for you, mate. Fancy a bottle of Bollinger?" Another, "I'll push it up tomorrow. We'll even out." It was corruption so casual, it barely looked like corruption at all. And soon Barclays wasn't alone. UBS, Deutsche Bank, JP Morgan, Citigroup, Royal Bank of Scotland. One by one, they were exposed. Each had manipulated LIBOR to make profits or to appear financially stronger during the crisis. The scale was staggering. This wasn't one rogue trader or a few bad actors. It was the entire system, incentivized to cheat. Governments launched investigations across continents. Fines piled up, $9 billion in total. But for banks that handled trillions, $9 billion was pocket change, the cost of doing business. A few traders were arrested. Some executives resigned. But the institutions themselves survived, untouched, unshaken, and richer than ever. The markets barely blinked. Investors shrugged. And most people never even heard about it, because the crime was too complex to fit in a headline. And when a crime is too complex to explain, it disappears into abstraction. To understand why it all happened, you have to look at what finance truly values. In theory, markets run on risk, on the price of uncertainty. LIBOR was supposed to measure that uncertainty. But when the entire world's financial system ties itself to a single number, a number controlled by the very people who profit from moving it, you don't get objectivity. You get choreography. And that's what LIBOR became, a carefully choreographed illusion of trust. By 2023, the scandal's ghost was finally put to rest. LIBOR was retired and replaced with SOFR, the secured overnight financing rate, a benchmark supposedly based on real transactions rather than estimates. Cleaner, safer, more transparent. At least that's what we were told. Because while the formula changed, the incentives didn't. The same institutions, the same culture, the same invisible hands guiding the world's money. The names evolve, the systems modernize, but the story never changes. The LIBOR scandal wasn't just about numbers. It was about trust, the invisible glue holding global finance together. When that trust breaks, everything else follows. Markets, governments, livelihoods. Every time a trader nudged a number, it didn't just move interest rates. It quietly reshaped reality. Your mortgage payment, your credit card bill, the taxes your government collected, the cost of living in your city. This wasn't victimless. It was a silent tax, extracted from every person on earth who borrowed money. But because the victims were invisible and the villains wore ties, it never made the evening news. There were no explosions, no chase scenes, no arrests that satisfied justice. Just percentages, small, silent, and deadly. That's how systemic corruption hides. Not in chaos, but in order. Not in secrecy, but in normalcy. When deception becomes routine, it stops being seen as crime. It becomes just how things work. In the end, the LIBOR story, the biggest financial crime you've probably never heard of, isn't really about finance at all. It's about the fragility of systems built on confidence. It's about how easily honesty can be priced out, and how power rewrites the rules to protect itself. The price of money, it turns out, was never just a number. It was a reflection of human nature. Greed, fear, ambition, and the illusion of control. And perhaps the most unsettling truth is this: The manipulation didn't end when LIBOR died. It just found new names, new metrics, and new justifications. Because the system never fixes itself. It merely evolves until the next generation believes the myth all over again. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.